welcome to episode 11 of Grow For It. This is a podcast for small business owners, managers, and professionals. The goal is to give me a chance to work with the space between your ears, your mindset, to help you focus on the things that really matter to your success. I want to enable you to concentrate on pursuing your vision, setting meaningful goals, and engaging in the day-to-day activities that will have the biggest impact. Thanks for joining me and investing a few minutes of your time. Well, welcome to episode 11 of Grow For It. We're kind of in a new season here with this podcast, and a lot has changed, so you're going to recognize a little bit different format this time. I used to keep these to about 10 minutes. This one's a little bit longer in format and form, and I've also got a guest today. My good buddy, Steve King, is a CPA at Meyerowitz & King right here in Louisville. Steve and I actually went to high school together, but he's handled my personal and my business taxes for many, many years. And I asked him to come in here to give us some background on kind of how things have leveled out with the new tax policy, the new tax laws, and also at the end of this to give us some tax tips for going into filing the 2019 taxes and things to think about for 2020. With that being said, Steve, first of all, thanks for your time this evening. I know it's been a busy day for both of us, so welcome aboard. I'm glad you're back.
Well, I appreciate you having me in.
Absolutely, brother. Some of you may have recognized the name Steve King. Steve and I actually did an hour-long interview back in May of 2018 on my local business radio show. That was a show called Let's Get It Started. And if you'd like to go back and listen to Steve talk about some of the things that are very important from a tax standpoint, you can still find that on iTunes, or you can go to my website, and there's a link on there to listen to my radio show. And all of it is still live, still available to you. And actually, in the show notes for this episode, I'll post a link directly to that page. But Steve, man, I really appreciate it. I know the tax tips and things like that are always stuff that you and I talk about. I mean, for those of you who don't know, Steve and I literally have offices almost right across the hall from each other. So we bump into each other and we talk a lot. When I started my new business going on 7 years ago, Steve was integral in, helping me get things set up properly and talking about things I need to consider and really doing a lot of coaching and guiding there. And I can't tell you how much I recommend Steve. I mean, Steve, I bring over clients all the time and say, here's the guy you need to be working with. So I appreciate having the resource right next door.
Well, we appreciate you as well.
No, it's your knowledge and expertise in this area. It's been extremely helpful. Let's go ahead and dive in here. We've got a number of things for 2019 that are really changes in taxes and things that have really kind of impacted the financial side of anybody's business, and in some cases personal taxes. But why don't we jump in? Steve, talk to us a little bit about the qualified business income deduction. Tell me about that.
Yeah, Jim, that's just an overhaul in the tax policy. So in my world, in the tax world, there's really 2 years. There's 1986 and 2017. And what that means is 1986 was an overhaul, and 2017 was about as big as overhaul. There's been many changes over the years, but those 2 years are the biggest group of changes.
Sweeping changes.
Sweeping changes.
Wow.
Yeah. And one of the biggest ones for small business was the qualified business income deduction.
And this actually kind of went into effect for 19 for this current year?
Yeah, the law was passed, I believe it was December 27th, 2017. It was the end of December, but did not go into effect until 2018. And so even with it going into effect in 2018, it was so new and there were so many nuances to the law. I think even when most CPAs were filing taxes last year, it was uncharted territory. So we've gotten more guidance on that now. Thank goodness, because it made tax season challenging. But basically what it is and the purpose of this new deduction was one of the things that got the most press during that tax release was they lowered corporate tax rates. Our corporate highest tax rate used to be 35%, and then it went to 21%.
Right.
But that's for your big companies. That's for your Facebooks or UPS, your large corporations. Well, this was actually kind of a last minute throw into the law, and what it was designed to do was to help small business.
Good.
So, but most small businesses don't pay tax. The owners pay the tax. So they couldn't,
like an LLC.
Correct. The LLC, an S corporation, a partnership. Yep. So those businesses don't pay taxes. The owners pay the tax based on the profit.
Okay.
So what this deduction was designed to do was lower the tax on the business. So it's a specific form with the 1040 that goes with it. And how it works is, in a broad sense, you basically only pay tax on 80% of your income. So what that means is you get a phantom 20% of your profit deduction. So hypothetically, after all your income and all your expenses, cash in, cash out, if you're left with $100,000 profit, you basically get to wipe off another 20% and only pay tax on $80,000.
Fantastic. I mean, that's a big deal for a small business. I mean, you're going to feel that.
It's a huge deal. Again, it's meant to compensate to help the small business owners as opposed to just the big companies.
Right.
But they didn't want to have a special tax rate, so they come up with this qualified business income deduction, or sometimes you'll hear it called the pass-through deduction, because businesses that don't pay tax, where the individuals, what pass-through means is the tax passes through to the owner.
Right.
So it's meant to compensate for that.
So when I first started working with you on my business, I had income. I had the Schedule C from the business. It showed my income and my expenses there, and I got down to the net profit, and that actually transitioned over to my personal tax. That was my income, basically.
Yeah, that flowed over to your personal 1040.
Right. So that passed through to my
That's
personal.
Correct.
And so this actually takes that down basically 20%.
That's correct. In some cases, there as with anything with Congress, they don't make it quite so simple. There's some caveats. You have to have a certain amount. There are some caps where there has to be a certain amount of payroll in your business.
Right.
And unless you're what's called a Schedule C, then you're already considered payroll. And then they carved out, as Congress usually does, to avoid too many people getting the benefit. They carved out some industries and said you don't qualify for this deduction if your income goes a certain amount.
Okay.
And mainly it's service industries. Not all service industries, more like the professional services. Doctors, accountants, lawyers, financial advisors. If you're over a certain limitation in your income, you may not get this deduction.
But it's there for the vast majority of small business owners.
Exactly. So if you're this phase out that I'm referring to doesn't apply if you're a restaurant owner or something like that.
So there's not really a cap for anybody that's not in those specific carved out.
Correct. Other than the wage cap. If your profit's $1 million and you have no employees, then you're going to get limited.
Trying to get there.
Yeah.
Okay.
Yeah.
Okay.
Exactly.
That makes sense.
Yeah. So it's complicated, and they're still issuing regulations. And I think probably last year, IRS, some of the forms weren't, I don't think, calculated correctly. And hopefully we've ironed all that out this year. Wow. And it's going to be a lot better to do. Now, there is some planning involved with that. It's if you can roll the dice and just get the deduction, or you can plan for that. Because, for example, one of the deductions that lowers your profit is what you pay yourself to a salary.
Exactly.
So a lot of taxpayers say, well, if I lower my salary even more, I get a bigger qualified business income deduction because my profit's higher.
Right, because it's a percentage. It's not
That's
a
correct.
It's not a defined dollar amount.
But the IRS is going to be look for that. So if you're an S corp or something like that, then you still need to pay yourself a reasonable compensation and not go too low to maximize what we call your QBI.
Okay.
But you also don't want to minimize it either, Jim.
Well, exactly. And you and I have these discussions.
There's a sweet spot that's fair for you and fair for the IRS.
Exactly. And you and I talk about this stuff all the time. Yeah. I mean, it's just, hey, Steve, I got an idea about this. That's the best thing and probably the worst thing of having your client right next door.
Yeah, that's right.
I tend to ask a lot of questions.
But that's a big one, and that's a significant business deduction for business owners. And again, that's sweeping. I mean, that's brand new, and it's obviously the whole idea is to spur more business and help business have more cash so they can invest and create jobs. I mean, that's the theory. Whether it's working out like that, I don't know, but that's kind of the theory. And it is a significant help to business owners.
Right. So take the money.
Yep.
Okay. That makes sense. Okay. Yep. Well, and that was called the qualified business income deduction. Now let's switch to another one here. This is called the qualified opportunity zones. Tell us about that.
Yeah, that's another one that brand new law. I think they had actually talked about doing that a few years before, and they never did, but they got it thrown into this bill. And what the law is designed to do, and this is for business owners, non-business owners, anybody that has capital gain income. Capital gain income be a sale of a stock, sale of a piece of real estate, sale of anything that creates what I would call capital gain, like
as defined on your tax form.
Yeah, as defined on your tax form, correct. So obviously, when you sell something and it's appreciated, you're going to pay income tax on that. And the whole idea of this law was there's a lot of pent-up capital gains that people say, well, I don't want to sell that because I don't want to pay the gains tax on it. So the reason for this law was to free up that money, so to speak, because if you sell this and you take the capital gain piece and you invest in a qualified opportunity zone, there are two tax benefits to doing that. The first is you don't have to recognize the gain currently. the gain on that sell will be recognized in the year 2026, no matter when you sell the asset, assuming you invest in the qualified opportunity zone. However, if you do that before the end of this year, which we're coming up on, you only got to pay tax on 85% of the gain in the year 2026. If you do not reinvest into an opportunity zone until next year, you'll pay tax on 90% of it. But it's still a 6 or 7 year deferral.
So if I have a building or a home or something like that, and I sell it, let's say I bought it at $100,000, it went up to $200,000, and I sold it. So there's $100,000 of capital gains there. In theory. At that point, I could take that $100,000 that I made, and instead of paying taxes this coming tax season, I could actually reinvest that in So you were telling me over lunch actually that Nulu, this for those of you who aren't local to Louisville, it's kind of an up and coming area of Louisville that they've kind of revived, and a lot of cool stuff is going on there. But because these opportunity zones are actually defined by zip code, I could actually go in and put something, or go in with a group of partners or friends and actually put an investment in this qualified opportunity zone and defer the capital gains that I would have paid upon the sale of
that's
that
correct.
asset.
Yeah, I mean the idea of the opportunity zone, what it was designed to do is free up money and get it invest in what I would invest it in low income areas. So the theory was this: is like, we'll give you a tax break if you'll go in areas that have maybe become depressed or whatnot. So they are defined by low income areas and set by the federal government. So what happened was the federal government said, as long as the guidelines meet this and it's defined as a low income area, the states are allowed to name the areas.
Right.
So in Louisville, for example, there's a whole tract downtown down into the West End that they want you to put money into, and they'll give you a tax break to hopefully revitalize those areas. It just so happens a hot area of town, Nulu, happens to be in an opportunity zone.
Wow! So
that means you can get that tax break by investing in a business or a piece of real estate inside in Nulu, or even down by the soccer stadium. It goes all the way. The new soccer stadium is in an opportunity zone. Obviously, that's already done and all that stuff. But I'm just saying that area is
around that area. Again, it's defined by the zip code.
Correct. Okay. Correct. It's meant to spur those areas along and get an investment in areas that you may not have invested in before. That's the theory of the law.
And I should at this point say, and wait, there's more, because what ultimately I'm thinking is that, okay, so I buy now a $200,000 or another $100,000 in this opportunity zone, and it appreciates over time.
Hopefully that's good. Yep.
Hopefully I hold that. If I hold that for 10 years, then what happens?
And then so there's two components. The tax deferral on the first piece. You don't have to pay it now. You do got to pay it at the year 2026, hopefully at a discount.
Right.
The second piece is the new investment. If you hold that investment 10 years, the gain on that property is tax free. So if you take your $100,000 and it grows to $200,000 in 10 years, and then you sell it, you keep your second $100,000, no taxes at all.
Fantastic.
So it's a great opportunity if you can find the right investment. Right. And there's been similar programs before, but I don't think they probably presented them correctly. So things like this have been around a little bit, not the opportunity zone, but something similar, and it hasn't been successful. So they tweaked it, I think, to make it better. I mean, the issue is going to be finding the right investment.
Right. And a lot of times on these, I think, hard asset like a building or land or something like that. What if I just sold a business? I mean, does that qualify for this?
Actually, not only does it qualify, actually the law was more designed for that.
Wow.
Because they want to get people opening businesses in areas where it maybe businesses don't open. The perfect example is when there's no when the Kroger on Breckenridge closed, and they said there's no grocery anywhere near there. So the idea was operating business, but real estate works as well. So yes, an operating business, and it doesn't have to be like, for example, maybe we should move our accounting firm down into an opportunity zone. Then I get the gain treatment on my firm. Now, not on my normal income, but if I sell my practice 10 years from now, if I can, then I get that tax free.
I'm still going to be around.
Yeah.
Don't do that. Okay. Well, fantastic. So, again, that can have some significant financial implications if you're in that position now. And again, there's a little bit of an extra bonus or an incentive if you're doing that in 2019.
Yeah, and honestly, if you're And if you're going to put your business in an opportunity zone and don't even realize it, you've got a great windfall that you're not even aware of.
Right. So you might want to start asking the question.
And honestly, the state of Kentucky has a website where you can literally go and type in an address, and it'll tell you whether it's located in the opportunity zone or not.
Which again is just defined by zip codes.
Yep.
Outstanding. Well, let's talk about this a
little
little bit.
Let me rephrase it. It's not even just zip codes. There could be some zip codes that are partially in it and partially not. You could,
so
in
it's
theory,
where you are in that.
Yeah, you could, in theory, on one side of the street, that's in the zone, and the other one's not. So you really got to know the address.
So you've got to be very careful.
Yeah, you got to know the address.
I'm glad you said that. So let's transition then to new equipment depreciation. The theory behind depreciation: I buy a piece of equipment, and instead of being able to deduct the whole thing for tax purposes, I normally would have to look at what is called the average life of that piece of equipment. And so I might have to take a little bit of a chunk on the deduction this year, a little bit next year, a little bit next year. And eventually the whole thing is devalued or depreciated. That has changed a little bit. What's going on here?
Well, it has. And so now there's bonus depreciation, which that in itself is not necessarily new. But this year you've got 100% bonus depreciation. And there's always been something called the 179. And what that means is, again, you buy a piece of equipment worth $5,000 as opposed to depreciating it over 7 years. You can 179 it all in 1 year and still get the $5,000 deduction this year. But there were some limitations to that.
Right.
So then they came out with a 50% bonus depreciation where you can take 2,500 of it that doesn't have any limitations. And then the other part over 7 years, now they have 100% bonus depreciation where you can take it all now. Now, in all three scenarios, all three are around, you don't have to do any of that.
Right.
You just have more options to do that.
Which is all I'm asking for. Give me the option to let me decide.
Yeah, because in some cases I'll say you may not want to take 100% bonus.
Right.
But it's available to you if you do. And a reason you might want to do that if you had a really big year and you don't expect a big year next year, or if you had income from other sources this year. Maybe your spouse got a severance package, or you got a big inheritance, so you've got
a bonus of some
sort, or you had to take a big IRA distribution from an inherited IRA. Bonus depreciation may offset that,
right.
And that's a one-time hit. So you want to take that full bonus this year.
So the household got a non-recurring event that a nice chunk of change land here that's now taxable.
Yeah,
this may be the time to go ahead and do a full depreciation on some new piece of equipment or something like that.
That's correct. Correct.
Okay, that makes sense.
And you can do bonus depreciation even if in your business you have a net loss, which you can't do with a 179, which was the first thing I was referring to. Now, you might say, well, why would if I had a net loss, why do I need the bonus depreciation? Well, if you had that other outside event that's non-related to the business, this can possibly offset that.
Right. So again, let's go back to a lot of small businesses are set up as LLCs.
Correct.
Maybe the LLC didn't make a lot of money. So when that transitions over to my personal income, it shows I really didn't make it, but your spouse actually generated a nice income.
Yep.
This would be another way to kind of offset the tax liability for the household.
That's correct.
By taking that
Well, that's correct. Another example, I had a client a few years ago. He was downsizing, got a very big severance, and he started a business, and he bought a piece of equipment. And that big bonus depreciation, he didn't have the 100% back then, but he had the 50.
Yeah.
100's better, but we used the full 50 to offset a good chunk of that severance package that he got earlier in the year.
Right. Okay. So, I mean, again, this comes down to planning. And this is one of the things over time. And if you go back and listen to my radio show, that's, like I said, it's still available on iTunes and it's still available on my website, jimrayconsultingservices.com. If you're doing any kind of business, if you're involved in anything like this, you really need to have a group around you. You need to have a team around you. One of the people on that team ought to be a very well qualified, highly experienced CPA. Like I said at the outset, I've recommended Steve for a lot of this work that he does with me, but also when I'm engaged with clients and this comes up. And I deal with people starting out new ventures. I deal with people who have been around who are looking to make a change, or maybe they're getting poor advice. Steve's fantastic, and I trust him 100%. He's handled this stuff for years, and I really enjoy working with you, Steve, and I appreciate it. So we talked about new equipment depreciation. Let's move over to something that's kind of related to family law, actually. So if I were paying alimony, or sometimes called spousal support, or sometimes maintenance, I mean, that whole area has now changed as well, right?
Yeah, it used to be deductible, and now
Yep.
it's not. So I mean, so if you were going to get divorced, you need to do it in 2017. So going forward,
Yeah.
and now that doesn't include child support.
Yeah, let's separate that. That's
just
not child
purely
support.
spousal maintenance, alimony, however you want to word it.
Yeah.
If you're paying that and you got divorced after the year in 2017, you're no longer allowed to take a deduction for that.
Okay. So that's just cash out. But again, that's something. And going forward, you can, I guess, use that as part of your negotiation. You're not going to get the benefit of the deduction.
I would think that was always negotiated in.
I would think so.
But now I think you would take that into consideration. I guess on anything if they don't know about it or one doesn't know, then they may not take that into account. Hopefully they do, and hopefully that's all,
right. And your attorney ought to be aware of that.
Should be. Yeah. I would think so. Yeah.
I would think so. Okay.
But it's important to know.
Well, yeah.
I think that's why you saw a glut of divorces right at the end of 17.
Nice.
You know what? Now that I say that, I think it had 1 year to phase in. I think you had until 8. I think that was the one. Typically when the IRS or Congress passes laws, sometimes they're phased in, sometimes they're retroactive. I believe that one phased in. I believe you could do that in 18. I mean, we're past 18 now, so I don't remember.
It's all past tense anyway.
So it is all past tense, yeah.
Okay. So now here's one that when you first mentioned this to me, as far as I was concerned, this was kind of a big deal. The new tax law impacted what I can claim as entertainment as a business expense. Kind of walk us through that, because for a lot of small businesses, a lot of people are in the field working with clients. We do entertaining. That's a normal way of cultivating relationships and developing new client business. Walk us through entertainment. What happened there?
Yeah. Not sure what the reasoning behind that was, but entertainment used to always be 50% deductible. So if you spent $10,000, you got a $5,000 deduction. And part of the Tax Cut and Jobs Act, they just eliminated the deduction completely. So if I were to throw an event, a client appreciation event or something like that, in years past, I could actually deduct a portion of that as part of a legit business expense. Correct.
But now that's no longer the case.
That's correct. Now, I would say if you're throwing an event and maybe you're renting a conference room and things like that, certain portion of that may be deductible. Mm-hmm. But if you're taking a client out to the UK, U of L football game and you're buying tickets, it's just not a deductible expense. You're allowed to do that, but you just can't take a deduction for it. It's 100% non-deductible. It's a little bit equivalent. Back in, I think it was the 80s, they passed, said country club dues are not allowed to be deductible. I don't know if there was just abuse or whatnot, but even if you join a country club to meet people that, frequent country clubs because they're good prospects for you. Yeah. Can't take a tax deduction for it. So it's similar to entertainment now. There may be some components to what you're doing, Jim, that we can deduct legitimately. Meals are still deductible, provided you're taking a client out or a potential client out and you're discussing business and you're doing all that. But just simply taking someone to a ball game or see a movie or something like that, it's just not a tax deductible expense.
Wow.
And I think, though, some of those things that they tried to get rid of with this new tax cut, which is kind of why they did the qualified business income deduction and why most of our rates got lowered. The theory, Jim, I think, was broaden the base and lower the rates. Broaden the base means I'm taxing more things, but I'm lowering your rate. So taxing more things, you can do that one of two ways. You can decrease deductions or increase things that are income to you.
Exactly.
That broadens your taxable base.
And in theory, it all works. But I know for a lot of us, entertainment was a substantial portion of our normal course of business. That's what we did. But there was also a financial incentive beyond just the new client relationship.
Sure.
But again, meals for the most part, they're within the laws, whatever. Yeah. There are ways.
Those are still deductible. That's correct. 50%, same as always before.
Okay. Yeah. Louisville's always been kind of a transient town in that we've got a lot of corporate headquarters here. We've got a lot of big businesses that tend to move people in, move people out, that promote people out. So, I might have been at headquarters, now I'm taking a field job or something like that. Moving expenses has always been an issue in terms of, so the company is going to pay to move me from Louisville to Minneapolis or something like that. But now even that has changed, right?
That's correct. Moving expenses are no longer deductible.
Okay.
Again, I'm not sure the reason behind this one, but at the end of 2017 was the last year to deduct moving expenses.
So if I'm getting relocated or if I'm just doing it on my own, I assume, hey, okay, I'm doing this for business. I'm going to incur these costs of a mover and all this other stuff. Maybe I'm in a short-term rental when I get there, so I can, find a place to live and things like that. And I've got some trips back and forth. None of that anymore is actually a tax deduction. That's going to be income.
Absolutely. That's great.
Wow.
If you're paying for it yourself, it's not a deduction.
Right.
If the company's paying for it, they're going to put it on the value received on box 1 of your W-2. So you're going to pay income tax on the value that they paid for, and you will no longer be able to deduct that expense.
Well, that used to be a nice thing to be able to deduct. Is that, hey, look, I know I've got to count that as income, but I had an offset. Now it's all income.
Yeah. And so it would be good to know that if that happens, so you can at least be
well, you'd want to negotiate
offer with your employer or your potential employer. Yep.
Yeah, absolutely. And that's federal law, so that's not just something that's germane to Kentucky state. That's federal law.
Everything we're talking about is all federal law.
Yeah.
And so it doesn't matter what state you're in that scenario, because the IRS or Congress don't care what state you live in.
Okay.
Okay.
Yep. Well, I got to incorporate in Costa Rica.
Yeah.
Okay.
There you go.
Okay. So let's talk about this. This is something that's a little different. And this is brand new. In fact, I don't think this is even law yet. So there's going to be a lot of guidance that's going to have to come out. But there was recently the new passage of something called the Secure Act. You want to talk about that for a little bit? And I know, again, a lot of it's still fuzzy, but you had a couple things in there that really, this is why you want to pay attention to this.
Yeah. And I'll definitely hit the highlights, because it has not it's been passed. President Trump has not signed the bill yet. I think it's anticipated that he will.
Right.
But it has not happened. So this is not law. But a couple of highlights on there is there's something in the investment world called required minimum distribution. It's called RMD for short, because required minimum distribution is a mouthful, right? And what a required minimum distribution is, most people, or at least are generally familiar with 401ks, IRAs, company retirement plans. So those, you can put money in and it grows, hopefully grows, tax deferred. So you've never paid, comes out pre-tax, you haven't paid tax on it. And that's a great benefit. And you don't pay tax on the earnings until you draw it out. Okay. Right. So Congress gives you a great tax benefit to invest for your retirement. However, at some point they say, you know what, you got to pay us. So when you hit age 70 and a half, you have to start drawing on your IRAs, 401ks, whatnot.
Those are your required.
That's required minimum distribution. So that's at 70 and a half. And it's an actuarial table. It's a table that tells you what's your value. This is how much you got to take out.
Okay.
And by taking it out, you're then creating a taxable event. You got to pay income tax on that. Well, they did one good thing with the Secure Act. One is they raised that from 70 and a half to 72. I don't believe any of this is going to kick in this year. It'll be 2020, at least what I've read so far. So that means you got a year and a half longer to leave it in there to bake and grow, so to speak.
Gains interest.
If you don't need the money. Again, you can take the money out anytime before that, after 59 and a half, without incurring a penalty, if you so choose. But if you don't need the money, people will leave it in there and let it grow.
This gives you the backside option to let it grow and go a little bit further for you.
So they gave a slight benefit, potentially.
Yeah. We got to see what else is in it.
Right. There's always, So one of the things that can happen is all IRAs or 401ks have what's called a beneficiary.
Yeah.
And that means who gets the money if that person deceases, right?
Right.
So generally it's a spouse or spouse and kids, or spouse and or, right? So with RMDs, one of the concepts is something called a stretch IRA. And it's really just a concept. There's no such thing as a stretch IRA. Right. It just means if you stretch out that IRA long enough and you're only taking out what's required, then you might be able to keep that IRA for 30 or 40 years, depending on the age. So hypothetically, someone passes away, it's left to their kids. Their kids may be in their 20s. The amount that they got to take out is very small. So that IRA may last till they're 70 or 80 if they're only taking out the minimum. They've now have changed that to say it has to be taken out within 10 years.
Wow.
So they took away a benefit.
And that could be a substantial hit for your beneficiary.
It could be, because if you think it this way, say someone's been able to amass $500,000 in their 401k.
Sure.
And they do not have a spouse, so they have one child, that child inherits it, and say they're a successful person, they don't really need the money, they could stretch that out for a long time. Now they're going to have to take it all out within 10 years. They're going to have to take out $50,000 or $60,000 a year, depending on the account balance and that kind of
taxable
stuff.
income.
And it's going to be taxable, and they don't really need the money. So it's basically getting the IRS their money sooner.
Yeah.
And it's hurting the taxpayer, at least compared to the old law, if it gets passed. Right. So that's a big negative.
That's called the Secure Act. And basically, I guess what you're saying is kind of keep an eye and an ear out for this, and kind of let's see what else is in there and see how that plays out. But that's a significant change.
Yeah, and I would never suggest anyone dying early. But
No.
what I'm understanding is if you pass away before the end of this year, then the new 10-year rule is not going to apply.
Okay, so you could avoid.
Kind of joking. Don't go do anything stupid.
There's probably some kind of disclaimer here. Well, Steve, before we wrap up with some tax tips for the end of the year here, these are kind of last minute things, and I know you and I typically meet and we go through a list of things. Hey, have you done this? Have you done this? Have you thought about that? Let's tell people how they can get in contact with you if they want to talk to you about kind of their taxes, their tax prep, and all the other things that you do. I mean, you and your partner Victor just do a tremendous amount of work for businesses, small businesses, individuals. And how can people get in touch with you?
Many ways, Jim. First of all, I'll give the website first. It's www.thelouisvilleoffice.com. That's all one word. I'm not going to bore you with the details of why that's our website name, but it's been that way for 20 years. Our office phone number is 502-587-9833. And my email address is stevek@mkcpas.com.
So it's Meyerowitz and King. So
yep,
MK.
Meyerowitz and King CPAs is the name. Phone number 587-9833. My email address is stevek@mkcpas.com.
That's fantastic, buddy. I appreciate that. And, if you're working with me, if you're one of my clients, obviously, at some point I'm bringing Steve's name up and we might get a coffee with Steve and just kind of talk about things that you might want to consider. But again, Steve, I appreciate your time. Let's do this. Let's wrap up this episode of Grow For It, a business podcast, with some last end of year tax tips. I'll let you take the lead. Let's go down the list.
Yeah. So first thing I want to add before I head into that is I think the biggest thing for any business owner is really maximizing their qualified business income deduction. And that can be based on their payroll. It may be a little bit late for that, Jim, to adjust your payroll up or down, but that I wanted to mention that because that's really, really requires pinpoint planning to maximize that. Being this late in the year, there are still some things you can do, and there's a few things you can do even in the first of the year. Like I think the biggest one that I see people miss, and it's not huge, but everything adds up, is most people do not max out their HSA. They don't.
And this is your health
savings account. It's not the old FSA. It's the HSA. It's not use it or lose it. The biggest thing where people don't max it out, a lot of people work for an employer that puts money in and they payroll deduct a certain amount. But even if that doesn't get you to the maximum, you can just make an outside contribution to get to the maximum. And that's the number one thing because it's a no-brainer.
And this is a tax deduction. This is a straight line tax. This reduces your tax liability.
Yeah.
Off the top.
Not dollar for dollar, excuse me. But it's a page one deduction.
Yeah.
In our world, page one is better than page two. Page one deduction's good. If you have an HSA and you have the cash, if you're not maxing it out, then you are making a tax mistake.
And not everyone qualifies for an HSA. I mean, there are certain things you have to qualify. But I've had one for a couple of years now, and I just renewed for another one going into 2020. But bottom line, that is money that I put into a savings account, and there are a lot of medical expenses that I can use this for.
Correct.
But how I use it doesn't create the deduction. What you taught me is that actually the money I fund that account with actually creates the tax deduction right off the top.
Correct.
So I could still in December write the full amount into my HSA, even though I haven't spent it, but because I funded the HSA, I get the tax benefit.
That's correct. So hopefully you don't have a lot of medical stuff and it grows and you got the deduction, whether it's sitting in your account or not. And you got the full deduction. And that can be done actually up until April 15th of next year for this year. Okay. So you do have a window there.
And that's a nice tax shelter. I mean, because if I didn't need to use those funds, I can leave those in there and those kind of roll over each year. Those roll over, then I use it or lose it, like you said.
That's correct.
So down the road, when let's say my income goes down, now I'm older and I start to have health issues, I've got money there.
You got money there, and it's coming out tax free.
Bingo.
You got a deduction in your high earnings years, you have no tax coming out.
I tell you what, that is as people look at this. I mean, that is one of the benefits out there that people forget about. I mean, this is a great plan. That's why there was such a lot of talk about this a couple of years ago about all these HSAs.
Yeah, and it's
different.
I think people forget because it's some of them have them through an employer, and they for whatever reason they can't get the max through their employer. But you literally can just write an extra check for the difference to get, and you should do that if you have the ability to do that. You should do that. And it's not a huge deduction because you can only put so much in.
Yeah, it's about 32 or 3,400.
But that's single for a family.
Yeah.
I think if you're over 50, it's 7,000 or 7,500. I should know that off the top of my head, but it's up there. You can Google that and find that real easy.
Yep.
But I put in the maximum every year for family,
Yeah.
and everyone who qualifies for this should as well. It's just a no-brainer.
And again, it's the fact that you funded it that creates the deduction. It's not what you actually spent it.
Yeah, hopefully you don't spend it. Hopefully it builds up.
Yeah,
but you still got the deduction. Yep, it's a no-brainer.
Okay. One of the other things you talked about was home office. And this is something, I mean, I know when I set up my business, you and I had that discussion is, okay, how is there a deduction for this? I mean, I'm allocating part of the house to this. How do we handle it?
Yeah. And the change with that's not new this year, but I still think it's misunderstood. There was an old way where you had to prorate the house and you had to get all your LG&E bills and all this stuff. And then when you had to, what's called depreciate that section of your house. So when you sold your house, there were some bad tax ramifications.
Yeah.
Well, a few years ago, they came out with what I would call a standard deduction. You're still supposed to list the square footage of your office versus your house, but pretty much everyone gets a flat $1,500 provided you meet the other requirements. And when you sell your house, there's no bad tax ramifications, so there's no tax add back like the old way.
Right.
And plus, it's not a huge deduction, but
it all counts. It all adds
in the day
up.
of the telecommuting, most people qualify, and I find that not as many people are taking that as should.
They're just not thinking about it.
They're not thinking about it. And it's not a huge deduction, but again,
it adds up.
It all adds up. The HSA, the home office, maxing out your retirement, it all adds up to significant tax savings.
If you now have to get a higher level of internet service or whatever to handle what you're doing at work. I mean,
if you're putting a booster on there or something like that, you can take that. If you have a separate phone line, it can't be back in the day when people only had home phones and you only had one line, you couldn't take that because I think the theory was you'd have a home phone anyway.
Yeah.
But now if you've got separate lines or you got a fax line, not that anybody has that anymore, but anything that's additional for your business, you can take as a direct cost.
And those, again, you can stair stack all that stuff. And it just, if you're working for yourself or you've got a small business and you're working out of your home, you got to think through these things because you win the game on these nickels and dimes, and that's it's just going to go away if you're not claiming it.
Yeah.
So talk to a CPA, talk to them about how you can maximize these things that are just sitting out there for you.
Yeah.
What about maxing out your retirement? One thing that you talked about.
Again, that kind of goes along with what we just said, along with the HSA. Again, if every dollar you put in, the IRS or Congress will give you a break. I shouldn't say that. If you have a 401k in your business, you actually can do a Roth 401k or the pre-tax, and that's a tough decision. I mean, the Roth doesn't give you a current tax break, but it gives you big future tax benefits. My advice on that is, should you take the tax deduction now and do the pre-tax bucket? Depends on your age, depends on your income, depends on all those factors. But in either scenario, hopefully you can max that out and either get current tax savings or big future tax savings. But once that year goes by, you can't do that. So every year you get a little bit older, try to do a little more, to do a little more if you can. Max those out.
And I think for a lot of people, they're always worried, well, what should I do first? The way I was always taught was, if your company has a 401k and they match, contribute enough to max out that company match, that's free money for the company. That's
free money, yeah. No, absolutely. I take it a little further than you, John. I'm like, always put in as much as you can.
but then, I'll take some out then and go, okay, so that's taken care of. Now look at, do you do your Roth or your regular 401k? Either way, but I would go, personally, I would say max out the Roth if you qualify, and then go to the 401k if you still have money to invest. It's all a way to keep money at work for you that just doesn't seem to evaporate at the end of the
and the tax savings you get is just extra return.
Bingo.
It's extra return,
and it's there sitting there for you. So remember, to start thinking through your accounts and have you maxed out your allowable.
And since we've known each other for a long time, we both hit 50 this year, and it goes fast. So save early because it comes fast.
I'm having that conversation with my kiddos right now. Yeah,
I'm sure that's going real well.
They're so interested.
Yeah.
Okay, so let's talk about some other tips as we round out these top 5 end of year tax tips.
Well, end of year thing, and this is something that has a year-end cutoff. I call it harvest tax losses, and that would be if you have investment accounts where you have gains. If you're not going to choose to invest those gains in the qualified opportunity zones, then you're going to have income tax if you sold a stock or sold a mutual fund that has gains in it. In most case scenarios, if you have a large enough investment account, hopefully most of your investments are gains, but you might have a few losses sprinkled in there too. So if you're getting to the year and you've got some gains, Sell the ones that are losers. It's called harvesting your tax losses. That way it'll reduce the capital gains tax you're going to have to pay at the end of the year or in April. The one thing you got to remember, if you sell something at a gain, it's always taxable, even if you buy it back the next day.
Yeah.
If you sell it at a loss, there's something called a wash sale rule. You can't buy it back within 30 days or you don't get to take the loss.
Right.
So you 31 days, really, you have to be out of it for 30 days. So that means if you bought Facebook at high price and you sold it at a low price and you sell it thinking you're going to offset some other stock and you buy it back the next day, you can't take it. And believe me, those brokerage firms, they track that.
Yeah.
I get statements all the time. It's got a little W code by it. That means wash sale rule, can't take the loss. So you got to be real careful. Yep.
But as you're coming to the end of the year, start looking at your portfolio.
Yeah, you should already be looking at it,
especially if you're an active trader, for, or somebody's managing that account.
Again, it all comes down. All of these things we talked about earlier that you can control. You can control the timing of all that stuff.
Yeah.
So doesn't mean you should sell and take the loss, but it's at least something to consider.
Right. You've got the option. Okay. And now, number 5 on the 2019 end of year tax tips. Where would we go with this one?
Well, I don't know if I'd really call this a tip. I'd call this a compliance alert. We talked earlier about the RMDs, the required minimum distributions with the Secure Act. Well, one of the things that happens if you forget to take your required minimum distribution, if you're required to take one, is you get an excise tax penalty, and it's basically 50% of what you needed to take.
Wow.
So let's say you were required to take out $10,000 and you forget. Well, your penalty on that is $5,000. And
that just comes right out, goes to Uncle Sam. You never see it again.
Yeah, it's right on your taxes, and it's significant. So don't forget. And so all the brokerage houses, wirehouses, all that stuff, they're pretty busy this time of year, and you got holidays.
Yeah.
So don't wait till the last minute, because if the paperwork gets messed up or whatever, and you don't get what's called that 1099-R, then that penalty's coming. So make sure you get your RMD out.
So if I've got a fund sitting in my retirement account and I've got to take $10,000 out, okay, and I forget, so now I'm January 10th or whatever, and oh my gosh, I forgot to take that. Do I need to still take the 10, but I have to give up an additional 5, or how does that happen?
Not at that point, you're already in a penalty situation. Probably what I would do is,
think it through.
I need to think that through. I don't know. I've never had anyone not take their RMD, so I've never really reset. But it's something, question.
Again, there's a required distribution date on there, and you've got to get that done. You have a good point about the holidays.
I don't think you take it out. What I think you do, I know there's a form you can file and ask for the waiver.
Yeah.
I don't think you're going to get the 50% waiver, but you might get there's penalties on top of that you might get. So you might get that waived. You might get the tax piece waived. I've just not had a client do that, so I've never come across that.
And I'm not old enough to do it.
It's so severe. And I will say, I mean, most of these brokerage houses, they mail like notice after notice after notice. Yeah. Doesn't mean people don't forget, but
or it gets tossed and you just don't think about it.
Yeah, or you think you did and you forgot. I mean, I'm sure it's happened before.
Wow.
I'm sure.
Steve,
let me just say one thing, and this might be where it gets lost. The rule is you just have to take out a certain amount. So if you have 4 IRAs, you don't have to take out something out of all 4. You have to aggregate them and take out a total. So you, in theory, could take it out of 1. And probably my guess is what happens is they thought they took it out of 1 and didn't.
Right. Okay. Okay. Steve, Guy, thank you so much for this. I really appreciate your time. I appreciate your expertise on this. I know. Again, we go through these kind of conversations quite frequently here. Part of that's proximity. Part of it's just I like talking to you. You know your business, and that means you know my business. I really appreciate that. Guy, I wish you and your family just a Merry Christmas, and hope things go well for you guys. I look forward to working with you again here in the future. Once again, before we leave, how can they get a hold of you?
Easiest ways, call area code 502-587-9833. My email address is stevek@mkcpas.com. And the website's www.thelouisvilleoffice.com. And we thank you, Jim.
All right, not a problem. Hey, guys, again, this is a little bit different format from what you're used to hearing from the Grow For It podcast. But Google's made some significant changes in how they treat podcasts, and that's going to take this in a little bit different direction. If you get a few minutes, drop me a line. Let me know what you think about the new format versus the short 10-minute podcast version that we did last go around. But anyway, a lot's coming up. I'll be happy to talk to you about that in a future episode. But this is a wrap for episode 11 of Grow For It.